See if that does that. Okay, record is on. If your instructors come into the class, I'm going to hand it over to them, but meanwhile, you'll have to follow up by email and see what went up with them, and I will show my desktop, load highlighter. Start. Going to host options, video layout, none. I am Professor Byrnes desktop. Apply. And where? This is my camera. Okay. So. Okay. I'm having to change thoughts here as I was just doing financial institutions class for my bankers. We're going to cover the tools of tax planning. I don't know what chapter it is in your books this semester. I haven't, as I always say, I'm just doing some instruction, helping out your instructors. Now where's my color here? Okay, what are the tools of tax planning that we have available to us on a international level? Well, first we should start with the domestic level. We can have tax credits. What else can we have? We can have deductions. Sometimes those deductions are with time being taken into account. Made into depreciations so that the actual deduction cost is limited on an annum basis, on a yearly basis, and then stretched out over several years. What else can we do on a international basis? Feel free to chat into your chat box. Exemption, 100%. What kind of exemptions do we have in the United States? As I've talked before, let's use our regular tax formula. This is the way I taught it last year. We used a lot of symbolic logic. I think I don't see any of the people from last year in class. But last year we used a lot of symbolic logic and formulas. And our symbolic logic and formulas, the very basic simple formula for determining our tax liability was our taxable income times the tax rate that applied to that income equaled the tax due. Then we subtracted any tax credits to come up with our tax liability, which was sometimes up and sometimes down. Sometimes we were in the money, being owed by the government a refund. Sometimes we owed the government. Our taxable income was calculated based on everything that fell into our gross income basket. We call it GI last year. And then we subtracted our deductions. And we applied any depreciation deductions we had. And give us taxable income. Losses, 100% Miguel. Losses, exactly. Losses are another tool to take advantage of our losses. I think in the last week we talked about double losses with consolidated filing, dual consolidated loss companies, right? And we have a lecture from that by, I think it's KPMG. So, in one of the previous lectures I gave this year, which I did not do last year, was on income, and it was on the fictional determination of income, which many people are now beginning to realize is a very relevant perspective, because we're now faced, well, certainly with the reality of changing U.S. GAAP to IFRS, and we had that lecture, I think, last Monday, a 2-hour webinar. You can go back and listen to it, following up on the Thomson Reuters site. And that's like, how does one value, for the banking crisis going right now, the credit crisis, mortgage crisis, whatever you call it, we have the question of valuation of instruments. And when you have instruments, let's call them mortgage-backed securities, like everyone else is doing, MBSs, sitting on your books, and those MBSs you've placed on your books at a value of, let's say, 10, and that value is mark to market, which simply means, in its basic essence, that whatever you could sell it for today, whatever the market prices of third parties who would buy and sell this, that's the value you must include on your books. And you had it down for 10, let's say your purchase price, and now the market won't buy it for anything. So is the value 0? And this becomes relevant for how we determine income, because, as Miguel said, losses are a tax planning tool. If instead of income we have losses, so when we have something valued at 10, now it's valued at 0, have we lost something? If we pay 10 and we can no longer resell it, now it might be a capital gains type transaction, or another type of category of income. Let's just assume for right now it's income, an income category, so we can play around with our concept of income, and then walk into these tax planning tools. And being that I was just lecturing on these type of instruments, it's very fresh in my mind. So let's look at the problem of valuation, which is going to help us determine the problem of income, which is going to help us to expand on our planning ideas to mitigate the inevitable effective tax rate. We have a normal mortgage-backed security, MBS. We all understand a mortgage is money's provided to a buyer of a house and or buyer of a piece of property. The loaner of the money, it's called a bank, places a security interest, which we call a mortgage, upon the piece of property, that if the buyer does not pay back the mortgage and interest, over whatever period of agreed time, then upon default of that obligation, the bank can inevitably seize the piece of property, auction it to pay back the mortgage, reclaim as much of its interest as possible, and if there's left over, that belongs to the person who took out the loan. Now, how one structures the actual mortgage is like a financial instruments class, which we'll be having in spring. And so we can structure our mortgage as interest payback over time, only interest payback for our interest deduction, which goes under number 2, planning. Interest only, with an inevitable sale of the property, because we don't pay back any of the mortgage principal, any of the principal of this piece of property to the bank. We make sure that we maintain for the personal point of view, we may be maintaining as best we can our basis in the property to reduce our capital gains, mitigate the capital gains, which inevitably, on a piece of property, there may be none if it's a personal piece of property in the United States. If it's held for investment, it may be 20% or less even. And we certainly don't want it to be income, because then it would be taxed at the high rate of personal income tax. Now, it becomes more complicated as we decouple the mortgage-backed security. This applies to shares also, in particular overseas. This is done quite often. So the share is reduced. The mortgage-backed security, the capital repayment may be decoupled from the interest repayment. So now you have these two streams. The capital repayment may be sold at a slight discount currently to one party, and the interest repayment portion of this mortgage-backed security, so now you've created two securities, that interest portion may be sold to another party. Now, to make it more complex, the interest portion, this income stream, let's say it's in US dollars because it's being paid by a US person. The buyer is a euro buyer, and the euro buyer says, I'd like to make sure that I get my same rate of return over the next 10 years as this is paid back, my same rate of return in euros. And I'm afraid that the dollar is going to devalue against the euro as it's been devaluing, and thus I'm paid back in dollars. I'm actually, when I recalculate my books in my functional currency of euros, I'm making less than I was making at the point I actually bought the interest stream. And so that party now does a interest rate, maybe credit swap with a counterparty somewhere else who says, I'll take your interest stream in US dollars and I'll swap you for my interest stream or my other income stream in euro, which is the equivalent of your income stream. And I'll guarantee you the difference, or I'll guarantee you if there is a difference. I'll take a risk on the devaluation of the US dollar versus your euro. Or maybe the seller of this interest stream, who's the euro player, will take that some of that risk, and they'll negotiate the risk between them. And then our instrument can become even more complex, and so on. And when we strip, first we decouple the mortgage, the actual capital repayment, from the income repayment. The value of the mortgage has been the value has been reduced. The actual mortgage itself, this mortgage-backed security, has been reduced, to the two things, but maybe the two have greater value alone than the whole based on what the market will pay for them yesterday. Right now, today, the market's not moving at all, so they have zero value. But at the time, maybe they were more highly valued. So if you bought it for 10 and the market valued it, and then you split it, and let's say each split is worth 7. So now split it's worth 14. I mean, this is the reality of what was happening. So now it's worth 14. Now the two buyers who, let's say, paid 5 each, and now it's worth 7, do they have to report 2 units of income? The difference between 5 and now the 7 it's worth, each of these two things, let's say, are worth 7. And if they did, let's say the following year, these should be in fit depreciating assets, because every year that the instruments are held, it's a year less of the income stream. So it's kind of like in the UK where you buy a piece of property on leasehold. Now it should be a devaluing income stream, but they're not devaluing. Maybe they're still worth 7. Maybe they're being valued at 7.5. So now do you put another 0.5 on your books as increased value? But is that income? And so tax authorities, coming full circle here, tax authorities, especially for banks and sophisticated taxpayers, corporations, General Motors with car finance, GE with their financial divisions and so forth, they come up with ways to, of course, capture as much income as possible, but being somewhat reflective upon the statement that made by King Louis XIV's famous finance minister, was it, I can't remember, Robespierre, who said you don't want to pluck the goose with the least amount of squeaking or squawking, and you certainly don't want to kill your goose. So the government's coming up with definitions for income to capture as much taxable liability as it can, with respect to not killing the companies that drive the economy. With people, we see this because scholarships aren't taxable, and the government could have the definition of gross income just be everything with no exceptions, no exemptions from tax. We don't, if you own a home and you sell your home and you reinvest those sale proceeds into a new home, that's exempt from income also. It'd normally be subject to capital gains tax. But that transaction under those specific situations are exempt from income. The government can limit losses. Let's say you have you buy a company that makes widgets, and your company is a technology company, and the company that makes widgets has a lot of built-up loss. Many systems say that the company that buys the technology company, the buyer, cannot take those losses against its tax liability unless it's in the exact same business as widgets, making widgets, and they call that ring fencing of losses. That's to limit the mitigation of tax liability so that the government can collect more tax. And these are, let's call them political decisions, in the sense that we're talking generally about democratic nations that have parliaments that set up a tax authority, and they tell the tax authority more or less what to do. And if people don't like it, they'll go talk to their politician, will, in theory, change the tax law, whether you believe in this or not. So income, as I think I said in one of these previous lectures this time around, is a legal fiction. Gains are a legal fiction. We establish a basis Then we use a legal fiction, a mark-to-market, for valuation of certain instruments. With property, for purposes of property tax, determining the value of the property for purposes of application of property tax, we use a mark-to-market. The assessor comes by every year and says the property is now worth 30% more than it was last year, so we increase your taxable basis for application of local property tax on the new value, even though you, the taxpayer, your income hasn't gone up by 30%. You don't feel the 30% increase in valuation from your property unless you go to a bank and you have to take out a loan to start paying your property tax. Again, that's a legal fiction. And so on. There are many examples of legal fictions. Not indexing capital gain to inflation also is part of the legal fiction game. If inflation is running at 5% a year on property, and you sell your property in 1 year for 5%, well, you haven't had a real gain. You're not going to experience any increase in wealth. All you've done is keep up with inflation. In fact, if you sell it for 4% and inflation's running at 5%, you've lost 1% in real terms. But you'll be taxed on the 4% you gained because we don't index for inflation. And so again, a legal fiction. Now let's apply this to the international situation where there's a lot more play. And for depreciations, I could just easily put timing. Okay. Let's start with exemption. We're not going to talk about controlled foreign corporation anti-deferral yet. We're not going to blend these tax planning tools with the inverse, the revenues perspective of how to mitigate tax planning, such as anti-deferral and so forth. Today we'll just talk strictly about the actual tools. So in the United States, corporate tax, let's talk about for capital gains, is the normal income tax rate for corporations at whatever barrier of income has been breached. As we know, we have a progressive system in the U.S. We can go look it up right now and see what the actual bands are of income. So 0 to 10, 10 to 20, 20 to 30, and see what tax rate applies for that particular band. And generally speaking, it's usually it starts off a lower tax rate for the lower band and a higher tax rate for higher bands. So let's say you choice to have a capital gain be made in the United States, or to have that same capital gain be made to occur in Hong Kong. Hong Kong doesn't tax capital gains. So if you take the maximum U.S. corporate tax rate of 35%, let's say, for corporations, although as I recall in the progressive scheme, and actually there's a little hump where it goes to 38% and comes back down and so forth, but say 35%. And for a 35% against the $100 capital gain, let's say that's the gain after basis, no indexing for inflation, we have 65. If we do the same capital gain in Hong Kong, you have 100. There's no tax rate. It's exempt from income for Hong Kong purposes, thus you 100. Well, then you'd, of course, say, well, why wouldn't everyone make their capital gains in Hong Kong? But we have anti-deferral legislation that addresses some of this, and one could partly say that, well, actually, companies do want to have their capital gains made in Hong Kong. It's one of the reasons Hong Kong is such an important financial market. If we move over to Singapore, we find a similar situation. It's one reason why Singapore at least many, of course, libertarian or supply side economists or so forth would say one of the reasons Singapore is becoming such a has been a stable and growing financial center. Dubai, why Dubai is becoming a stable and growing financial center. Okay, so that's exempt from tax. Now, let's say that the company is a Hong Kong company. The United States, by example, as we know, I think most of us are U.S. people here. No, let's see. David's from China, Miguel's from Mexico. Well, I take that back. We're not mostly U.S. Lottie's from Africa. So, but in the United States, we exempt from tax capital gains of non-residents. Thus, we're doing that as an incentive for non-residents to buy and sell shares, like, by example, in the New York Stock Exchange, NASDAQ, or to own U.S. assets. The Hong Kong company, if it makes a capital gains in Hong Kong, or if it makes a capital gains in the United States, but is non-resident, and those capital gains are not associated with a branch in the United States, and we've already talked about branch taxation and so forth in earlier lectures, well then in that situation the Hong Kong company will have no taxable income, and so we never have to get to the step 2, what is the tax rate? It's exempt from tax. Along those same lines, any other type of transaction that would normally occur in a taxable jurisdiction, that we can move the transaction out of that taxable jurisdiction and associate it with another jurisdiction that doesn't have as high a tax rate or has no tax rate, so your typical Cayman Islands type tax haven. If we can associate that transaction with a foreign jurisdiction and with a foreign taxpayer, because in the U.S. obviously we have worldwide income tax, then we have eliminated the taxable income aspect, at least the immediate taxable income aspect on that income. We never have to get to the TR question, the tax rate question. Again, it's a 0. Again, today we're not taking into account anti-avoidance legislation like anti-deferral that might deem a dividend from the earnings and profits of the foreign taxpayer overseas, or in another jurisdiction. It could be in Canada. So there are ways to establish exemption from tax just by simply having transactions and taxpayers in other jurisdictions, not the high tax jurisdiction that you're concerned with. Sometimes, what is the high rate of tax in the UK right now for corporate transactions? I think it's 29%. It was 30 and they moved it to 29. Did they move it back to 30%? I don't recall. I can go look right now using all these research tools we have, but does somebody know off their head what is the high rate of tax in the UK right now? Because I know one of the John McCain campaign pieces is, the United States needs to reduce its corporate income tax because he says countries like Ireland, and I know Ireland is a low rate, are significantly lower than the U.S. and encouraging people to move their business over there because of the low rate. I don't see anyone responding, so nobody seems to know off their head. Let's 29%. So it's a 6% difference. Let's say cut to 28, says Lewis. Okay, so 28. So there's a 7% difference right now between UK and the US. Now, that 7% can be very significant, obviously, for a larger corporation. If we're talking about $100 million income, $100 million taxable income, you'd be talking about $7 million added to your bottom line, which can be used for shareholder payouts, increase your dividend, increase capital investment, and so forth. Let's move on to the deductions, depreciations. But further, you might have 7% difference, but you might also have, under number 3, timing deductions, you may have an accelerated depreciation. It used to be, Ireland used to, I haven't checked in several years, but I remember back when I used to practice, one of the really nice or interesting aspects of the Irish tax system was that it's for some types of investments in the approved investment field, such as financial services, manufacturing, and so forth, you get accelerated depreciation. So instead of, by example, let's say in the United States, that if you invest in a type of capital equipment that the depreciation period is 10 years. Well, let's say that the UK or Ireland is saying if you invest in that capital equipment in our country, first of all, we already have a lower tax rate than yours, but we're going to allow you to accelerate that depreciation to 5 years, both straight line. Well, obviously the 5-year depreciation is more valuable contrasted against the 10-year depreciation. You'll get your deduction in half the time. But let's make it more interesting. Let's say that the foreign jurisdiction says, we'll give you not just accelerated over 5 years, but we'll give you, for the first 2 years of depreciation, we'll further accelerate it by example 30% of your total investment cost your first 2 years, so that 60% you capture back your first 2 years. The remaining 40% you'll flatline over the next 3 years of your 5-year accelerated depreciation. Well, very interesting. It's obviously worth more than a 5-year flatline depreciation. And governments are offering these kind of things all the time. Even the U.S. has accelerated depreciation in certain industries, like shipping has always been a big one for the U.S. And right now we have lots of, and if Aaron was here, you could tell us since he was the counsel over at British Petroleum, the oil industry lives on these depreciations and credits for its capital investment. So then you can get into double depreciation, where with Ireland in some situations they'd say, we'll give you a 200% deduction. Now what's the deduction worth? It's not worth as much as a credit. A credit is dollar for dollar against your tax liability. So a deduction is worth if you have a $1 liability, we'll say 100, so I don't have to use cents. $100 liability, and your normal deduction would be 10, and the normal tax rate, and we'll just use England as our example, is 28%. Then your 10 deduction from a tax perspective of savings is worth 2.8. That same deduction in the United States, if the U.S. is a 35% rate, would be worth 3.5. Some people teach this, or some economists refer to this, and I do it on education expenses. If you're deducting them, they'll say, well, the item you're buying doesn't really cost you 10, because if you just have the 10 and you don't buy the item, you have to pay tax on it. So you're left with 7.2 in my first UK example. but on that same analysis, if you spend the 10, you're not spending 10, you're spending 7.2. The government is subsidizing the 2.8 through the interest deduction, or through the deduction in this case. It applies to education. If you spend 100 on education, you're allowed to deduct 100 for education. Then you're not paying 100 for education. You're paying 100 minus your tax rate that would apply to that 100 if you didn't spend it on education. You spent it on something that was not a deductible activity. Now the UK might say, or Ireland used to say in its situation, we're going to give you, if we favor this type of investment, a 200% deduction or depreciation, because we know that your depreciation is worth more, your depreciation deduction is worth more overseas in the country that you're based from than it is here. So we'll give you a 200%, so your 2.8 is worth 5.6 against your tax. So the real cost of your depreciation is, the real cost of your investment is 5.6 by 10, so it's only 4.4. Because we're subsidizing, the government's subsidizing it for your final tax bill, 5.6, 200% depreciation. Okay. So the just going to check my sound level. Okay, so that's the depreciations can be a very important tax planning tool from the and you have to look at each country's depreciation schedules on the type of investments and so forth you're going to make. And if the country has a development agency like U.S. states have, many U.S. states have this to reduce the U.S. state tax. Territories have this, like certainly the U.S. Virgin Islands and Puerto Rican investment authorities are the most known, but Guam has it, and Palau and the other little territories. So then let's look at our deductions as just normal deductions for fees, service fees, management fees. And we call that extraction of income. So in the first one you had exemption, and we talked about depreciation. We also have extraction of income, and you have your entity in one country, you have another entity in another country. We'll say they're inevitably owned by a whole company somewhere. We'll say tax rate 35%. We'll say tax rate, I don't know, 0%. And our directors for the company, which control the holding company and the company in the 0% jurisdiction, they provide strategy and financial strategy, corporate strategy, business strategy, and then financial strategy assistance to our country A company at 35% tax. Let's say that you could compare those two types of services, the corporate business strategy. Let's say you can compare that to hiring McKinsey, by example. McKinsey, that strategy firm. Let's say you could compare the second type of financial strategy to like an investment bank, hiring a Goldman Sachs. Let's say that the fee for each is well, last year I used to use a lot of symbolic logic. So whatever. So I'll just give it a number. So we'll say it's I'll call your investment fee F. And so with extraction, I want to reduce my tax base made of my taxable income minus my deductions, depreciations. I want to reduce my tax base by extracting income and tax base from my country A company to my country B company. And there are many ways to do that. One we just looked at was management fees, or in this case business strategy, and they can be charged at whatever the fair market value for that type of service is, or the investment fees. We could do it through interest. You extract interest through making loans to your company. So the traditional route was you have your country A company. It pays interest, a deductible expense, to your group company in country B. And if this is a 0% tax, and this is 35%, simplifying this extremely, you're reducing your tax base here in country A so that your inevitable tax rate, when applied, will equal less tax, therefore due. Whereas in your country B, your taxable income, your tax base would go up. There is no tax rate, so you have no tax due. When summarized with all your other operations, this brings your effective tax rate down. Anti-avoidance-wise, therefore, countries like A seek to limit how much interest you can pull out of the companies to B. Now, they can't say no interest payments because we need financing in the world to make the world run. We need credit being extended and loans being made and interest being paid so that we don't have what's happening today. So countries, to encourage interest payments, to encourage, i.e., loans, can't say no interest payments allowed or no tax deduction for interest payments allowed. So they say things like, well, we're going to limit the amount of deduction you can take for interest payments. We might limit it based on equity, your debt to equity ratios. In the United States we call it earnings stripping. We might limit it to the fair market rate of interest charged for that type of loan. We might limit it to a combination of both of those. You can't charge more than the fair market rate for that interest. Neither can you, or you can't take a deduction for more than the fair market rate. And you can't take a deduction for the interest paid that exceeds a certain ratio of interest to the amount of equity the company has. Now, right now, it's going to be really tough, these interest ratios to debt, because debt to equity ratios, because companies aren't able to book any equity because they got a lot of instruments and they're booking a lot of debt. So they're in a worse off scenario where they're not even going to be able to take deductions for their interest made to parties overseas. And so the tax code, from some countries' examples at least, is going to exacerbate the problem that's occurring in the market. There should probably be some kind of temporary relief on this while assets are revalued. Okay, so we got exemption, like the capital gains example, or moving a transaction from one country to another. Moving part of the value-added chain from one country to another, and that's spoken about in your materials and your instructors are supposed to be talking to you about value-added chain. For those of you doing transfer pricing has a lot to do with value-added chain, and that course there's a lot of different lectures on value-added chain and moving aspects of the value-added chain. I'll talk about that next before we finish this. We've got the extraction, whether it's like fees or interest. We got different types of depreciation investments. We can go on and talk about tax credits, but we know that's coming in a few weeks. On your syllabus, you're going to spend 2 weeks on tax credits and talking about gaming for that. With losses, we talked about the double losses with dual residency when we talked about the potential for dual residency, well, even triple losses. And there's also that lecture on dual consolidated losses on your calendar. So these are all tools that exist in a tax planner's toolkit, generalizations over the kind of things to look at amongst different tax regimes, that is, different countries. And even in the United States, amongst the different states, or in Switzerland amongst the different cantons, or in Canada amongst the different regions, the domestic tax planners look at the variances, whether the variances are based on definition variances, which I talk about a lot, or application variances, tax rate variances, incentives, like the double depreciation or double deduction. Obviously, we have tax credit incentives given too. I was just today discussing Louisiana film credits for Louisiana state tax purposes for filmmakers. And those are special credits given by the legislature of the state of Louisiana to encourage people to have films there. Most states have that kind of thing. Or tax credits given for the auto industry to build a auto plant in the state. Okay, so let's talk about value-added chain. This is my company income pie. This is to produce $100 through the sale of a widget. I'm again simplifying this for purposes of our discussion. In the transfer pricing class, there's about 20 there's about 5 or 6 specific lectures on value added, but on this course too, your instructors are supposed to cover value added, so you can, because it's one of the more important aspects of tax planning on an international level. So we have to divide our pie up between, let's see, the commonality things. So we'll have labor. We have to further divide labor up. We have the cost of goods that go into making the widgets. We have the cost of the manufacturing, the operational costs. What other kind of costs do we have in making widgets? And selling widgets and getting $100 from the sale of widgets. Well, we've got marketing costs, market promotion. We got design costs. We got management costs. In order to get to this final 100 as a sale to a customer, we got sales costs. We have to break that 100 down into all the various elements that went into it to get to the 100. Another way of drawing the same model, most people draw it as a circle. I've always drawn a straight line. And in transfer pricing classes, I describe it as a breath of air that created a human being. So our inevitable outcome is a human being, and before the human being there was nothing. And so you got the two opposing camps. Those who believe biblical strict interpretation, breath of air from God, human being created. And those who look at a long evolutionary path. And to get to the human being, starting with one cell, and it moves up to lizards, and however it gets apes and human beings. I'm definitely not an evolutionist, but I think it's just a hypothesis. But anyway, it makes for a nice transfer pricing or value-added scenario. So I say, what goes into making this? Now, if it's the breath of air approach, then that breath of air is worth everything. The whole value-added, the whole transaction model to get to my human being, under the first process, let's say the human being is 100, and my cost of the sale a widget. So that process of that breath is worth 100. If you look at it evolutionarily, there's all these like evolutionary steps that take place, and I could put names on them. But let's start with, like, we got the one cell, and then we got the lizard, and then we got the little one steps, and then we get the dinosaur. I don't know how that fits in. Then we got the bird, and we got the monkeys, and then we got human being. Which one of these steps from our one cell to the human being, if the human being's worth 100, my thing keeps erasing. Sorry, I don't know what's up with it today. Which one of my one steps is 100? It's another way of saying, like with the breath, if you took out any of these steps, would you still get to the human being? Using that logic, all of them are worth 100. If you can't get to the human being, you might be able to take out dinosaurs. Like, let's say that dinosaurs are not relevant. Dinosaurs never existed, still get to human being. Let's say that my birds aren't relevant. Birds never existed, you still get to a human being. So they're worth 0. Let's say you had to have one cell creatures, you had to have monkeys, you had to have reptiles, and so they could each be worth 100, but they have to add up to 100. They have to sum to 100, because that's the final sale price for my widgets. So I got to allocate. Well, I could allocate all of them equally. I could say, well, there's 4 steps still left, so I'm going to give each 25. That's one way of valuing them. But could value it as our monkey step was less important than the one cell becoming a lizard. Now that was a really big jump in human evolution. From one cell and poof, lizard results, walks on land, and the one cell was like floating in the ocean. Huge jump up. That's worth 50. That's half the game. Because once you had something on land, everything else was inevitable. Okay, so if we take out our human example, we make it widgets. Still the same type of valuation game. To make a widget, I have to have sales income to find my customer. I have to have customer support after they bought my widget or they're not going to buy my widget. I got to have finance so that they buy my, so they can afford my widget. They're going to need to borrow money from me. I'm going to have the, I'm going to have to buy the widget from somewhere else, whether it's me making it through my factory or a third party. And so we'll call that sourcing operation. Where am I going to source my widgets, or whether it's myself or third party. I have to have management. I have to have my labor's too general. We're talking about like sales labor versus management labor versus all the other types of labor that I have to go in. So we can go through a little brainstorming exercise for each type of industry and come up with a brainstorming of all the elements that go into producing the income, the 100 from that sale of that widget. Everything that goes into that process, from the very beginning of some entrepreneur manager has to exist to have the idea to do all this. And then we have to value each of these sources against, from a transfer pricing perspective, a third-party valuation. What do each of these elements to get to my final income, what are they normally worth in the marketplace? By example, the sourcing part of this, if widgets are a commodity, like paper cups, like Starbucks. Okay, Starbucks sells coffee. Coffee is a commodity. You can go buy coffee. There's lots of sources to buy coffee from. If you want to be a Starbucks, you can go buy it from traders in your local jurisdiction. You can buy coffee internationally. If you got a lot more money, you can actually go to the market, the international markets, and buy coffee from Brazil. You can fly down to Brazil yourself and bring back bushels of coffee, or you can containers of coffee and so forth, and be like Starbucks. Paper cups, that's commodity too. Stores on every corner in a city is interesting perspective on marketing coffee. Anyway, the point, Starbucks has built we have a trademark and goodwill, and there's some team presumably behind it thinking about maintaining its trademark, improving its trademark, promotion, marketing its trademark, and so forth, so that people walk into a Starbucks and for the same cup of coffee that I pay $1.50 at one place, I pay $2.50 at a Starbucks. And so I have all these different elements that go into the valuation of Starbucks' inevitable sale of $2.50 for its cup of coffee. And what's the most important here? Well, if every other company does everything else at Starbucks, they do everything that each other do to make a $1.50 sale, but then Starbucks selling for $2.50, they got to do something different and unique. And what that different and unique is they got to trademark Starbucks. One has to determine what this unique value is. And now, if a buck of the $2.50 is allocated to the trademark, almost half of the value of the income of my $2.50 each sale. If my trademark is placed in a jurisdiction that does not have tax, then versus all of these different elements of producing my $2.50 for a cup of coffee, if they all exist in the same jurisdiction with high tax, well, certainly my first option of having it placed in another jurisdiction without tax reduces the effective tax rate for the company. Now, there are consequences of doing that, from having to respect anti-avoidance to things like losses. One can say, well, like with pharmaceutical companies, they can base all their patents overseas. Well, that would also mean that they're placing at least if they're doing it correctly, if your risk of your production is overseas, that also means the risk of all the losses are overseas. And you don't want to be in a situation where you have a company sitting in a no-tax jurisdiction that's built up 100 loss that you can't take against anything. You want to take your losses in your high-tax countries and your profits in your low-tax countries. And, of course, the opposite is the interest of the revenue authorities. They want you to have your income in the high-tax countries and your losses in the low-tax countries, and or not in their countries. Or if you do have losses, they want it offset by the income. So your trademark, if it's developed in America and you spend all your money in America, you can still move it out of America, but you got to pay whatever the value is for it, as under the valuation formulas that are, third-party consistent. And for transfer pricing purposes, there's a special type of recapture in the future income streams from that trademark, so that you can't move it at today's price, because the U.S. government's not dumb. And today's trademark price, well, they know that you can't fit it today's, that has a future value too, and they want to capture some of that future value in terms of income in the local company that's going to be taxed. And so they added a clause to the law, the transfer pricing rule 482, that said if you sell something like your trademark overseas to an overseas subsidiary of yours or whatever, and you're going to pay it license fees to use trademark, now you're going to reduce your U.S. tax base. Make sure that you sold it for the value, for the commensurate value that it's worth. What that means is on a forward-looking, ongoing basis. You can't sell it at what it's worth today based on what you did in the past. You have to base it on what it's worth based on the value that it's going to be worth in the future. And so they would, if you move it overseas, they'll tax it as if it was still in the U.S. Or there's other remedies for the service. They'll increase the amount you have to pay for it, and so on. Okay, so that's this is looking at the example of doing for your company a total value-added cycle to get to your final income level, and from the value-added cycle to then see what aspects of the value-added cycle that you can displace from one jurisdiction to another jurisdiction, or on a go-forward strategy, business strategy basis, when you know you're going to be setting up investments or new markets, what elements can I place overseas? And then the rest of this course, international tax course with your instructor, should be addressing some of these issues. With labor, you might source all your labor from your local country, but you could have a subsidiary overseas in a lower tax jurisdiction, if the business numbers made sense, that acted as your effective recruiting agency. And that company did all the work for recruitment, because most recruitment is not done face-to-face anymore. It's done through internet, like Monster.com and TaxJobs.com and things like this. And everything's exchanged by email, and a lot of interviews now are starting to take place on internet, like we're doing right now, teaching with the webcam. And further, the interviews are taking place with video conferencing, and two-way and interactive, and recruiters don't see people. In fact, recruiters never meet their people. They're in the different city than the company they're representing and the labor they're representing, and which we talk about in our career services course. So the company's recruiter can be overseas, and the company's recruiter, let's say the recruiters normally charge 1 month of the salary of, so 1/12 of the amount. So if your payroll was $10 million, and a recruiter would normally charge you 1.2, and you set up a recruiting for it, you can charge somewhere 1 million to 1.2 in theory. many companies that have gone through this exercise, not because of tax, they're doing it like with a Anderson Consulting, whatever that's called now, I forget, and yeah, they're doing it with a McKinsey, and they tear apart their value-added chain, and they discover all the sectors in their value-added chain and how much value they place them, where they can do them to save money, and they might be looking at saving labor costs or cost of goods or enhancing their market exposure or just alleviating risk, whatever their reason is for undergoing the study and valuation. They discover new product lines for their own company or new income streams. Like they go and set up a recruiter service firm for their own people, and they discover, well, you know, we could do this for other companies too. In fact, this, what used to be a cost center now becomes a profit center for the company going through this exercise. This is not a tax-driven exercise. This is a business-driven exercise of which tax is one of the elements. And it's an important element, but no more important than saving the cost of manufacture, saving the cost of each of the sectors. And part of the cost is obviously the tax cost, but there are many other. And then you got the risk mitigation of having all your eggs in one basket. You don't want to have all the exposure to, by example, today, the U.S. market. A lot of companies had set up recruiting firms in Ireland to take advantage of this kind of thing back, 10 years ago. That risk exposure was different. They were actually employing a lot of Irish. They were employing Indians and so forth and moving everyone around the world, and they were creating tax savings because they really needed to have this service for their company. And they actually found that they could in-house what they were doing to third parties, or certainly they still used third parties, but they managed the activity and they reduced the cost on the third parties. They made tax deduction payments to their Irish subsidiary. But one of the reasons Ireland is because they were hiring a lot of Irish. But the mitigation here was Ireland ran out of labor. Ireland 20 years ago had plenty of labor, and they were educated labor. And then 7 years ago, the labor supply had all been hired up. And now Ireland was having to bring people in to fulfill its own domestic economy needs. And so, of course, now you have labor supply companies, and South Africa was sucked dry of all of its labor, and doctors and nurses and so forth. And so now you focus on India and China and other markets. It has a lot to do with education levels and the cost of that labor relative to the cost of other labor. So there's many reasons one mitigates exposure to different marketplaces, and tax is one of those mitigation reasons to be taken in relative to the other ones. Okay, that's really the big picture of the tools of tax planning, which obviously I was not prepared to give today. I'm just sitting in because your other faculty didn't show up. What is are there any questions about our tools, such as interest or exemption, deduction, and this kind of thing? This was recorded, and yeah, I have to go teach my other class also. So it's actually not teaching; it's a blog that we share ideas. Well, it's definitely recorded. In fact, I'm going to turn off the recording now. But if you have